Brandon here from Building Wealth Flow. Today I thought I'd do a little bit of an impromptu. I kind of wrote something up last night. This is my strategy and how I look at investing from my background of investing as a stockbroker and advising others to today where I invest and why and what I've seen over the last 3 decades that gave me concern with other investment strategies. This last weekend we were down at Sandfest in Port Aransas and looking at castles, beautiful castles made of sand, don't have the permanence and melt away over time versus building a foundation on the rock. So stay with me today as I go through 4 investment principles of what I do to invest that maybe prompts you to say, I want to do the same things. Please like and subscribe. It helps the algorithm and gets this word out to others. And make a comment if you appreciate it or questions you may have. So stay with me here. Let's get started. So, the definition of investing is parting with capital with the expectation of safety and a rate of return either by interest, dividends, or maybe in rents, producing cash flow. We invest for the long term and where people are succeeding in investing with assets that produce income, not on how much I can sell it for in the future over decades from now, where values seem to fluctuate through the years of what people value. And in some ways, it's a form of gambling. I would not quite call it that, but we don't have the idea of what the value will be 20 years from now, what people value, or that the values change on the next headline. You know, I've seen several of my colleagues over the last couple of decades who were investing in the stock market, about to retire, and the values declined within 6 months of their retirement, and they had to work another 5 or, in this one person, 7 years more because their values declined, because they have to sell that asset to pay the bills. I chose to go another path because of what I've seen over the last 30 years. I wanted to have more control and have assets that I didn't have to sell. So I want to go through the very first one, and I do have notes on this first one reminding me points I want to talk about. But the very first one, the most important one, and I talked about it in my 10 laws of investing of what I do, and I think it was in law number 3, but in this one it's going to be the number 1 discussion, and that is, and I'm going to write these down, that is possession. Make sure I spell this right. I've learned, for me and for those that are really succeeding at a high level, they have possession, they have control of the asset and control of the outcome. Those that invest in Wall Street tend to have to live on the hope and decisions of others, be it the CEO or others that are in leadership. But those that are in Wall Street that have more control, it may be a good investment. For me, I wanted more control over my own destiny. And even with that, say, hey, if I succeed or fail, it's based off of my decisions. The only one I can get mad at is not someone else, but me in how I've handled things. And then, so the question that I have is, do I have an asset that I can have the ability to affect its value and affect the income? Those are questions I had to ask, And when I was getting into really focusing on retirement, I went into the real estate side. Do I have an asset that I hope goes up in value 10, 20, 30 years from now? Do I have an asset? And what I think about, if we look at the stock market, I know I'm using a lot of that, but I'm comparing the two with real estate and with stocks. Look at the S&P 500. Over a 10-year period, almost 50% of the S&P 500 changes in a decade period. I also think back in the 1950s, they called it the Nifty 50. People were investing in those 50 best companies back in the 1950s. Guess what some of those were? Kodak, Polaroid, Kmart. Final one that we've seen collapse recently, Sears. Those values have changed over the decades, and we didn't have control over the decisions, and we would watch decisions. I remember watching decisions by Sears and watching the CEO make poor decision after poor decision that collapsed the value, or he sold off the value of here you own the stock and the CEO is selling off value of, let's just say, the Craftsman brand, or the real estate assets that had high value he would sell. Interesting. He would sell those and yet you own the stock. But think of those that we didn't have control over. So what I'm looking for is the ability to control the equation. How much the value of the property is. Am I taking care of it? Am I doing value add processes in it? Does that property, is it in an area, did I pick a property where the values are stable and increasing? I look at slower growth because I find that it grows, and if it does decline any, it declines slowly also, just for a short period of time. So I'm looking for that slow, steady growth, not these high growth markets. And I think of Austin, Texas. If we remember back to the COVID period, Austin, Texas massively shot up in value. And what has happened over the last few years? It has massively gone down in value. But yet here where I live in North Texas, the values did not grow quite as near as fast. Yes, they've gone down a few percent here in North Texas the last year, but not much. I'm looking at things that don't quickly trade. So when you can trade in a second, the values fluctuate so rapidly. I wanted assets that took time to sell because the values were more inelastic. They didn't fluctuate. They tend to be more stable and you make a better decision. So it's not, investing in the stock market, that may be your decision, but I wanted to have more control. And when I have more control, I have better returns. And where the highest returns, where the wealthy live in controlling the investments, is in the 14% return and higher. That's the fourth condition of money, is where the wealthy money is. All right, number 2, I'm going to put down, and I'm going to get the right marker, protection of principal. I wanted to be in an asset where I'm going to part with capital that I have high degree of protection of the actual principal I put into it. I underwrote, I now have possession, so I am underwriting the process, because I even look at some of the syndications, and these syndicators were learning on your dime, didn't underwrite it well, created these fancy slides, PowerPoints, brochures. I wanted to underwrite it based off of my decisions so that I could protect the principal. Buffett, I did think about it and I actually heard about it recently on another channel, Wealth Outside of Wall Street, and I loved him bringing it up. Buffett had two principles that he talked about. Principle number one is protect your capital. Protect the principal. Only invest in things that you protect the principal. And rule number two is remember rule number one. Don't forget to protect principal. So that's what I want to look at when I'm investing in real estate, because I have, number one, possession. I know I'm underwriting it conservatively, and I'm thinking of all kinds of worst case scenarios. I look at break-even analysis. I want my break-even analysis, worst case scenarios. If it were to decline by at minimum 15%, I'm still covering all my expenses, and even in that 15%, still putting back reserves for CapEx. So true break-even is even less than the 15%. Number three, and I'm going to talk about this, is permanence. If I have to, and what I'm talking about, how long will this investment last? Will it last for infinity because it produces cash flow, or do I have to sell the asset to pay the bills? How do I pay the bills when I want to get into retirement? It goes back to the 7 habits of highly effective people. Have the end in mind. What is the end when I'm in retirement? Before retirement, I'm trading my time for money. After retirement, I don't have to trade that time for money. I want to have that money to pay the bills. Do I have to sell the asset that I own for retirement to pay the bills? So my retirement, if I'm investing in stocks, steadily declines, and they use this 4% rule that has been talked about since the 90s. I'm having to slowly meter out selling my assets, and I'm selling, say the market declines significantly when I first get into retirement. I'm now in a high stress situation versus real estate. One of the things that's happened lately in my real estate, the property value has declined by about 5% in the last year. But all those values, because you make money 5 ways, are work independently. My cash flow has actually gone up from a previous video I've created. Even though rents have gone down 2%, 3%, my actual cash flow has gone up because I have, once again, possession, number one. I have control over the decisions. I worked hard on different expenses, optimized my expenses, and created more revenue and more cash flow. So in retirement, I don't have to worry about the values. I'm buying my investments based off of cash flow, paying the bills in retirement. That cash flow will grow over time throughout the years. And number 4, final thing, and I've just been talking about it, it is number 4 is produce cash flow. This, I've talked about it multiple times. From number 1, possession, having control over the decisions. My assets succeed or fail because of my decisions. And who makes better decisions for me and my family? It's me, not someone else in a syndication, not someone else in Wall Street. I want to have control. I've seen it over and over again throughout the decades. I make better decisions for me than someone else making decisions. Number 2 is protection of my investment. Number 3 is permanence. When I retire, I don't have to sell the asset to pay the bills. And number 4, I only invest in assets that produce cash flow. How does that produce with what I'm doing? is how much does it produce in money that I've invested? Do I also pay taxes on that cash flow? The investing, the tax code is an incentive plan. And the most incentive plan in the tax code is owning real estate. There's so many ways that you can manage your taxes or reduce them down to zero. Or worst case scenario, when you're finally having to pay taxes on assets that produce cash flow, what a problem is that? You're finally having to pay taxes because it's producing so much cash flow over and above all the expenses, all the depreciation expense, the non-cash event. What a problem to have. But then you can still borrow against the appreciation, increase the interest expense, but pull out all the appreciation in extra cash tax-free. I want to own assets that the IRS likes and that the banks like, and in turn, I like. I'm making money in a multiplication effect using healthy leverage in an asset the bank loves to finance, but I finance conservatively, so then I'm growing my wealth in a multiplication effect versus investing in the stock market is an addition effect. You're doing $1 produces $1 versus the multiplication using healthy leverage. $1 is at minimum healthy leverage doing the work of 4. That's why you can get to retirement 4 to 5 times faster with real estate, good investments in real estate versus saving your way in the stock market. That's my opinion. That's what I've experienced, and that's what I've seen over the decades. So I hope this helps you. The 4 P's, I know I'm alliterating here: possession, protection, permanence, and produces cash flow. Thank you for listening to the very end. I wish you the very best. Please like and subscribe. From Building Wealth Flow, Brandon Potts. Talk to you soon.